A staggering £100 billion has been wiped off the value of UK homes in just the past year. That's not a typo. 100 billion gone. Entire neighborhoods are seeing homes sit unsold for months. Estate agents are slashing prices and buyers, they're vanishing. Could this be the beginning of the biggest housing market crash in modern UK history? You might think this doesn't affect you yet, but whether you rent, own, or dream of buying a home, what's unfolding right now could impact your finances in ways most people aren't prepared for. Why are house prices falling despite a national shortage? Why are landlords dumping their properties? And what's happening with mortgage rates that's scaring even seasoned investors? In this video, we're breaking down 10 powerful and surprising reasons why the UK housing market is collapsing. Backed by hard data, expert opinions, and economic signals you can't ignore. This isn't just a market correction. It could be the start of a total reset. Stay with me until the end because the final reason might be the most shocking of them all. Number 1. Skyrocketing interest rates. Just 2 years ago, you could lock in a mortgage with an interest rate under 2%. Today, that same mortgage might come with a rate above 6%. And if you think a few percentage points don't matter, think again. On a $250,000 mortgage, the difference between a 2% and 6% rate is over $500 extra per month. That's $6,000 a year gone just on interest. This massive shift is squeezing buyers, scaring off investors, and putting enormous pressure on homeowners. It's not just a number. It's a tidal wave hitting wallets across the country, especially among younger households already stretched thin. So what's causing this rate explosion? The Bank of England has been aggressively raising rates to fight inflation. The goal? Slow spending and cool the economy. But the side effect, property becomes painfully unaffordable almost overnight. Lenders tighten criteria, deposits get higher, and the dream of home ownership feels even further away. Mortgage approvals are plummeting. According to UK Finance, they're down more than 25% compared to last year. Sellers are slashing prices just to attract interest. Viewings are down, chains are collapsing. First-time buyers are increasingly giving up hope. And here's where it gets even more dangerous. Millions of homeowners secured low fixed rates during the boom. But many of those deals are ending soon. When they remortgage at today's rates, their monthly payments could double. If they can't afford it, they may be forced to sell quickly. Forced sales mean price drops. Price drops trigger panic. Panic stalls the market. And if house values fall below mortgage balances, we enter negative equity territory. The same financial quicksand that trapped thousands during the 2008 crash. Skyrocketing interest rates aren't just a financial adjustment. They're the fuse that could ignite a full-blown housing disaster. Number 2. Declining real wages. While home prices have soared over the past decade, wages not so much. In fact, once you adjust for inflation, real wages in the UK have either stagnated or declined since 2008. According to the Office for National Statistics, average weekly earnings today buy you less than they did 15 years ago. That's a quiet crisis, and it's hitting the housing market hard. People simply aren't earning enough to keep up with the rising cost of living, let alone qualify for a mortgage. With food prices, energy bills, and transportation all rising sharply, the dream of buying a home is slipping out of reach for millions. This is more than just a temporary dip. It's a fundamental affordability crisis. Let's break it down. Mortgage lenders typically cap what they'll lend you based on income, often 4 to 4.5 times your annual salary. But if your wages have barely budged in real terms while property prices have doubled, that maths just doesn't work anymore. Even middle-income families are now struggling to afford average homes, especially in major cities like London, Manchester, and Bristol. Young professionals, nurses, teachers, people once considered solid buyers are now priced out or stuck renting indefinitely. This wage-price disconnect also fuels housing inequality. Wealthy buyers, often with family help or cash, can still afford to buy, but everyday workers are left behind. This widening gap creates long-term instability, not just in housing, but in society itself. When fewer people can afford homes, demand weakens, sellers adjust expectations, and over time, prices start to fall. What we're witnessing now isn't just a slowdown, it's a structural breakdown in affordability. Do you feel like your income hasn't kept up with housing costs? Let me know in the comments. And if you're finding this breakdown helpful, don't forget to subscribe for more insights like this every single week. Number 3, buyer confidence is shattered. You don't need to be an economist to sense it. Something's off. Ask around and you'll hear the same story. We're waiting. Prices feel risky. What if they fall right after we buy? It's a shift that doesn't show up on the listings page, but it's real. Confidence is crumbling, and when people don't believe in the market, they stop participating in it. Psychology plays a huge role in housing. When buyers believe prices will keep going up, they rush in, fearing they'll miss out. But when headlines warn of falling prices, high interest rates, and economic uncertainty, that fear flips. Now the fear is buying too soon, getting stuck, losing money, and it's not just talk. Nationwide reported a clear fall in buyer sentiment across the board. Google searches for house price crash UK have surged. Viewings are down. Offers are cautious when they happen at all. This isn't just hesitation, it's paralysis. Chains fall apart because one nervous buyer backs out. Sales collapse last minute. Sellers drop their price shopping to stir some interest. But even price cuts don't spark action like they used to. Everyone's waiting to see what happens next. The irony, this lack of confidence becomes self-fulfilling. Fewer buyers mean weaker demand. Weaker demand leads to more price drops, and every price drop reinforces the doubt. The whole thing spirals. People remember 2008. They remember the headlines, the panic, the homeowners who owed more than their house was worth. No one wants to be the one caught holding the bag this time. So, here we are with buyers sitting on the sidelines watching the market from a safe distance. And as long as they stay there, the market stays frozen. Sellers wait, buyers hesitate, and the market holds its breath. Number 4, flood of new builds and oversupply. At first glance, building more homes sounds like the perfect solution to the UK's housing crisis. More supply should equal lower prices, right? But in practice, the story is far messier, and the surge in new builds may actually be making things worse. Over the past few years, developers rushed to cash in on ski-high property prices. Entire blocks of flats, suburban estates, and commuter belt developments sprang up across the country. Local councils pushed for planning approvals. Government schemes like Help to Buy added fuel to the fire. The goal was simple: build fast, sell fast. But now demand is stalling. And what's left? Thousands of newly built homes, many in areas where buyers are drying up. In some regions, especially in parts of the Midlands and northern England, supply has completely outpaced local demand. This oversupply creates an uncomfortable situation. Builders are slashing prices just to move stock. Investors are avoiding buy-to-lets in oversaturated rental markets. And in some places, brand new homes sit empty month after month. There's also the quality issue. In the rush to build quickly, some developments cut corners. New homeowners have reported widespread issues: poor insulation, bad plumbing, unfinished roads. When buyers hear about this, it only adds to their hesitation. Even worse, a flood of discounted new builds can distort local markets. They undercut existing homeowners trying to sell, pushing overall prices down. And once prices start falling, confidence erodes even more. So, while more homes were meant to be a solution, the unchecked growth of new builds without matching demand has added another crack to the market's fragile foundation. In-housing more isn't always better. It is to be the right homes in the right places for the right buyers. And right now, we're far from that balance. Number 5, landlord exodus. A silent shift is happening across the UK property landscape, and it's coming from the people who once saw housing as the safest bet around. Landlords are leaving in droves. Over the past year, thousands of Burley properties have quietly returned to the market. Not because tenants moved out, but because landlords are fed up. New taxes, tighter regulations, and shrinking returns have turned a once profitable investment into a financial headache. The numbers speak volumes. According to Property Mark, 46% of letting agents saw landlords selling up in 2023 alone, and the reasons they're stacking up fast. First, there's the mortgage pressure. Many landlords relied on interest-only mortgages with low rates. But with interest rates soaring, monthly costs have ballooned. For some, rental income no longer covers the mortgage, especially in cities where rent caps or tenant protections are tightening. Then there's taxation. Section 24 changes phased out mortgage interest relief, slashing profits. Add capital gains tax on sales, higher stamp duty on additional properties, and localisensing schemes. And it's a fiscal minefield. The result, more properties shitting the market all at once. And not just any properties. Rental stock that is to be stable long-term investments. When these homes go up for sale, supply spikes, prices dip, and potential buyers see it as a red flag. Renters are affected too. As landlords exit, rental options shrink, rents rise, competition increases, and housing insecurity grows. This landlord exodus isn't just about disgruntled investors. It's a symptom of a market turning on itself. A system that used to reward long-term property holding is now pushing people out. And with every exit, the balance between supply and demand tips a little further. This shift isn't loud, but its impact on both sale prices and rental stability could be enormous in the months to come. Number 6. Bank lending tightening. Money may not have vanished, but access to it has. Banks are getting stricter, more cautious, and far less generous when it comes to lending, and that tightening grip is squeezing the housing market from the inside out. In uncertain economic climates, lenders become risk-averse. The Bank of England's Financial Stability Report confirms it. Loan-to-income ratios are falling, high-risk mortgages are being cut back, and banks are now stress-testing borrowers at much higher repayment levels, often assuming rates of 7% or more, even if the current product is lower. That means even if a buyer has decent income and credit, they might still be told no. Not because they can't pay today, but because banks fear what could happen tomorrow. And that kind of restraint locks thousands of potential buyers out of the market altogether, especially hard-hit. First-time buyers and self-employed applicants, many are being asked for larger deposits, sometimes 15% or even 20%. That's tens of thousands of pounds more upfront just to qualify. For younger buyers, that extra hurdle is enough to delay or even cancel their plans entirely. It's not just fewer approvals. It's smaller loan offers, too. Someone who might have been eligible for a $300,000 mortgage a year ago may now only get $240,000. That directly impacts how much house they can afford and what sellers can realistically expect to receive. Lending rules have become a quiet gatekeeper of the market. It doesn't shout like interest rates or grab headlines like inflation, but its effects are just as powerful. All this creates a ripple effect. Lower offers, fewer sales, stagnating prices, sellers grow frustrated, buyers feel locked out, and the entire system slows down. When credit tightens, the market loses its heartbeat. Without that heartbeat, everything begins to stall quietly but relentlessly. Number 7, cost of living crisis. Forget mortgages for a moment. Many households are struggling just to cover the basics. The UK's cost of living crisis is putting intense pressure on everyday finances, leaving little room for long-term goals like home ownership. Energy prices have soared. Food inflation remains stubbornly high. Insurance, transport, childcare, virtually every expense is climbing. According to the ONS, over 90% of adults reported an increase in their cost of living in the past year. And that extra burden leaves less money available for savings, deposits, and monthly mortgage payments. It's a domino effect. When families can't save, they can't buy. When they can't buy, demand slows. And when demand slows, the market stalls. Even those who might technically qualify for a mortgage on paper often back out when they calculate their full monthly outgoings. Many buyers are taking a second look at their budgets and realizing they're one big bill away from disaster. A car repair, a rent hike, or a heating bill in January could be the tipping point. That financial fragility leads to caution, and caution slows the market down. On the other end, homeowners aren't immune either. Rising utility bills and grocery costs are eating into their mortgage affordability. Some are skipping reorganizing altogether and selling instead. Others are downsizing not by choice, but by necessity. And let's not forget renters. With rent prices rising and wages stagnating, many are locked in a cycle, spending more than half their income on rent, unable to save for a future move or emergency. This crisis isn't just about individual hardship, it's systemic. It weakens the entire housing ladder from the bottom up. When basic living costs consume the bulk of income, buying a home becomes an afterthought and the market suffers at every level. Number 8, aging housing stock. Take a walk through many UK neighborhoods and you'll notice something striking. Lots of homes are simply old. In fact, more than half of the country's housing stock was built before 1965. That's charming on the outside, but costly on the inside. Aging properties come with problems: poor insulation, outdated wiring, drafty windows, inefficient heating systems. These issues aren't just inconvenient, they're expensive. And with new environmental standards and stricter Energy Performance Certificate, EPC regulations, many older homes now fall short of what's considered mortgageable or energy efficient. Buyers today are more cautious. A beautiful Victorian terrace sounds great, until the survey comes back with $20,000 worth of repairs, and in today's economic climate, most people can't afford to spend that kind of money on top of a deposit, stamp duty, and legal fees. Landlords are backing out too. Proposed regulations requiring rental properties to meet higher EPC standards by 2028 are scaring off investors who'd need to spend thousands on upgrades. For many, it's simply not worth it. And those who stay, they're passing the costs on to renters. The problem compounds. These homes sit longer on the market or sell at reduced prices, dragging down overall values in certain areas. Some sellers are forced to renovate before listing. Another added cost in an already squeezed environment. New builds have their issues, but aging stock presents a slow structural decline in appeal. Buyers want modern, efficient, turnkey-ready homes, and the market is struggling to meet that expectation. The UK's housing crisis isn't just about supply. It's about suitability. And right now, too many of the homes available don't meet the financial, energy, or lifestyle needs of today's buyers. As long as the majority of properties lag behind modern standards, the entire market remains weighed down, one crumbling brick at a time. Number 9, government policy shifts. Housing markets don't exist in a vacuum. They're deeply shaped by government policies, and right now those policies are in flux. The shift in direction from aggressive housing support to regulatory tightening is leaving both buyers and investors unsure of their next move. Take Help to Buy, for instance. The scheme, once a lifeline for first-time buyers, ended in 2023. It helped hundreds of thousands get on the ladder by lowering deposit requirements and offering equity loans. Without it, entry-level buyers have lost one of their main tools for overcoming affordability barriers. Meanwhile, there's been a noticeable absence of new buyer-friendly policies. No replacement schemes, no major support plans, and no clear roadmap from Westminster. That silence breeds uncertainty, and uncertainty stalls markets. For landlords, it's a different kind of turbulence. Tax reforms have eaten into profits. Rental reforms are on the horizon, and whispers of rent controls make many feel like the government is hostile to private renting altogether. The result? A policy environment that feels unstable and difficult to plan around. Local authorities haven't helped either. Regional councils are rolling out their own rules. Licensing schemes, zoning restrictions, and development slowdowns, all of which add red tape and unpredictability. Even energy efficiency standards are tightening, pushing some investors to exit entirely. Stamp duty changes, which once sparked bursts of activity, are no longer having the same effect. Buyers see them as temporary moves, not long-term commitments. That weakens their power to drive sales. Housing thrives on clarity and consistency. When people know the rules, they plan, they buy, they invest. But when policies shift without warning or vanish entirely, confidence fades, and with it, activity slows. Number 10, global economic turbulence. The UK housing market doesn't operate in isolation. It's part of a global economy, interconnected, volatile, and increasingly unpredictable. And right now, those global tremors are starting to shake our foundations at home. Inflation spikes in the US, interest rate shocks across Europe, supply chain disruptions from China, and conflicts in Eastern Europe and the Middle East. All these global forces send ripples across borders. Investors get nervous. Currencies fluctuate. Capital flows dry up, and housing seen as a stable asset starts to wobble. International buyers, once a key source of demand in UK cities like London and Manchester, are pulling back. Currency risk, tighter overseas lending rules, and political instability are all pushing foreign investors to look elsewhere or simply wait it out. Global financial markets are also affecting mortgage rates. UK banks don't just set rates in a vacuum. They're influenced by global borrowing costs. As Treasury yields climb or global inflation surges, banks adjust their lending prices accordingly. That trickles down to every borrower in Britain. Even construction isn't spared. The global price of raw materials, steel, timber, copper, has been all over the place. These cost pressures either delay projects, shrink profit margins, or push prices even higher. Some developers are even pausing new builds entirely. And let's not forget the psychological factor. People sense uncertainty everywhere, from their news feeds to their bank balances. That constant hum of anxiety causes buyers to hesitate, sellers to hold back, and developers to pause. The result? A fragile domestic market exposed to external storms. When the world gets jittery, housing slows. When confidence dips globally, activity shrinks locally. In an era where everything is connected, global turbulence isn't just background noise. It's a force that can reshape the entire housing market. And right now, that force is growing louder and harder to ignore. So, do you think the housing market is collapsing, or is this just air set? Drop your thoughts in the comments. We read every single one. If you found this eye-opening, check out our last video. It dives even deeper into the signs most people are missing. We put a ton of work into making these videos to keep you ahead. So, if you appreciate it, hit that subscribe button. It's just one click, but it means everything to us.